Welcome back to the Insurgent Mindset. I'm Matt Tice.
And I'm Rondo Moses. This is a podcast about challenger thinking in a world shaped by disruption.
In each episode, we explore the strategies and leadership mindsets that help businesses break from the pack and stay ahead in fast-changing markets.
You'll hear conversations, case studies, and insights from leaders who are applying these mindsets to thrive in this uncertain environment.
Subscribe to our YouTube channel or follow us on Apple Podcasts or Spotify, and check out our companion blogs at insurgentsgroup.com for a summary of takeaways from each episode. Let's get into it, Rondo.
Sounds great.
So, Rondo,
How
what
are
are
you,
we going to talk
Matt?
about today? We're going to talk about I've come up with a working title for today's talk, which is as a mid-market business owner, how do you avoid getting your pants pulled down by private equity?
Yeah, I like that. I like that. I like to think of it as imagine two CEOs, same industry, both probably running the same earnings, let's say $5 million in EBITDA business. But there's one CEO who is really focusing on the current performance of the business. It's profitable business, a good business. They have loyal customers, but they operationally, this business demands that the founder or the CEO is involved. They rely on that CEO for, let's say, some of their key customer relationships. The CEO can't step away from the business for any long periods of time without things going south. Maybe even the customers are, revenue is concentrated in the hands of a few customers. So that kind of business is good business, but it's not the kind of business necessarily that would command the best, I would say, multiples if they were going to talk to a buyer. So that's one business. And you have another business where same level, but the CEO could step away. The business processes are documented. They have diversifications of customers, so not a lot of concentrations of customer revenue in a few customers. And they have a very deep leadership bench, unlike the previous CEOs companies. That business would probably command a lot more in terms of multiples than the other business. Same size businesses, same EBITDA earnings, but one business is much more attractive to buyers, and another one would not necessarily be, would actually take a discount from a buyer in order to get them. I think that's what we want to talk about today.
Okay, so I guess what you're hypothesizing here is that there is um, almost a leadership premium on one hand, but then also um, a diversification of risk premium as well, right? So
Mhm.
I suppose they're both sort of the same thing in a sense that a business that's over-indexed to a particular leader will be less valuable than one that has diverse management talent across a broader capability base, and so on. And same applies for other factors, I suppose, too, talent, customer, et cetera. That is pretty interesting. And I suppose if you sort of unpack that a little bit, you may find that business A might be more typical of a founder-led business, right? Where business B might be more typical of even if it's a private company of a of a professional CEO running that business, right? With the appropriate incentives and so forth. But I think it
Hmm.
really comes down to, right, if you think about like what is your goal as a private business is to, or should be, to maximize and optimize the value of your business at all stages of its life cycle. Is that fair,
Right.
Rocco? Right? So
Absolutely. Absolutely.
then the question then becomes to what are the levers that you can pull to unlock that value today, middle term, long term, so that when it comes time to exit on one hand, or when comes time to raise capital, or whatever you need to do regarding, or even debt when it comes to bringing resources into the business to drive growth or achieve your other strategic aims, that you're on the front foot rather than on the back foot for these kinds of negotiations. So I think it's really interesting the way you frame that because leader A, I think, is typically going to be on the back foot, right? The founder either wants to transition the business to the next generation, but it
Yep.
still stands on its own merit that that business should be as valuable as possible, right? Business leader B is a little bit ahead of the curve in terms of, is a little bit more in tune with the dynamics of what is actually going to drive up that value. But I would say that even A and B, most of those leaders tend to be disproportionately focused on value through the EBITDA and revenue growth lens, but
Hmm.
not focused on or not typically focused on the multiple side of the equation with regard to sort of magnifying that value, right? So consequently, I think a lot of times business leaders in mid-market companies leave value on the table, which then that value is hoovered up by the private equity or the family office or whatever who's making the acquisition or providing the capital. So I think it's really important that the leadership mindset here, I think to me, it delineates into are you a taker of value, right? In other words,
Right.
someone else comes in and takes the value
Right.
from you, or are you a maker of the value? You're engineering your enterprise for that value by pulling the right levers at the right time, given the context and what you want out of the business and so forth.
Absolutely. I think that's exactly what we need to unpack today for our audience is how to think about the taker versus the maker, and then how do you, if you're a taker, how do you move to becoming more of a maker?
Okay. Well, let's start then with what is the taker mindset? And just for our own taxonomy here, which has a lot of interesting parallels to kind of the traditional incumbent mindset, right? So,
Mhm.
what are the characteristics of the taker, Rondo?
I would say the characteristic of the taker is that they're managing for current performance as opposed to overall managing for current performance as opposed to managing for value creation. Because
Mm,
you would operate the different, and that's why you could see those two, CEOs, same earnings, but a different value when it came time to sell, different multiples in essence, when it
mm.
came time to sell. So I think that's the big picture is that one is managing performance is definitely a profitable business, but they're not really managing for ultimately value creation. I think that's one big thing.
I agree. And when you talk to these leaders, typically the CEO, the founder, um, these individuals are often not thinking about, raising capital right now, or not
Right.
thinking about exit that may be, off in the distant horizon. But I think the point that you made is a valid one in a sense that, business leaders need to sort of make that transition to become value architects, right? So I think the taker finds themselves at a real point of disadvantage, particularly when approached by an acquirer, for example.
Hmm.
So if you don't have your ducks in a row, even if your business is profitable, it's been growing, you got a good team, you got happy customers, that's all good, but sort of threshold to your earlier point. But the problem is that you're going to be on the back foot because somebody else knows what those levers are that are going to drive your multiple up and down, but you don't. So you're not planning that. So I'll just give a couple of examples. So like a taker will, on average tend to be much more short-term focused. What's next
Hmm.
year's performance? You mentioned that. I think that's really important. Um, a taker will think about the drivers of EBITDA and revenue growth, but not the drivers of the capital value of the business, right? So maybe
Hmm.
because they don't understand it, or maybe because they're not thinking about right now bringing capital into the business or exit or whatever. They're just not thinking about these things. So then, consequently, when the taker gets approached by a third party, they're going to be playing defense, right?
Right.
So in other words, they've got to scramble to try to meet the needs of the acquirer, who is going to end up taking all that extra value in maybe not this transaction, but the next one. and leave that money on the table for the founder or the CEO of the sort of with the taker mindset. I think that's really problematic. If you have let's to your example, I have a $5 million EBITDA company. That business trades at 4 times EBIT. Okay, great. I walk away with 20 million. But
Right.
with a little bit of architecture and engineering, you can drive that multiple up to 5 or to 7, right? You're talking about huge leverage in terms of getting more value. Whereas the marginal little bit of extra EBITDA growth or a little bit of extra revenue growth doesn't really magnify that value. So, yes, you have to focus on those things, but you also have to think about um, how do you drive that extra multiple value.
Yeah, and in that example, that means a difference between $5 to $10 million additional dollars, if
Mm.
that's the gap. And so people have to, CEOs and leaders have to decide that it's worth it to get that optimal, whether it's they're selling or whether they're trying to get a loan from a bank, they need to have the maximum valuation that they can get so that they can come out ahead. And that's why this is important to understand
And
this
I would
concept.
make the argument that that stands on its merit regardless of where you are in your business, right?
Absolutely.
So, one thing that startup founders in this era are really good at is eye on the horizon for exit, right? Um, the going concern business, right? Maybe 20, 30, 50 years, second generation business or whatever, they by default seem to operate like takers because those individuals are not programmed to think about how to unlock that extra value. So, I agree. I think it is a problem, but what can they do about it? Let's talk first about what a maker looks like, right? And then the contrast, and then maybe how do we bridge the gap and help the taker sort of understand better how they can shift that mindset and understand that at all times your business is, creating or releasing capital to generate more value. I mean, I think that's the goal.
Yeah, I think one of the big things is that makers are focused on improving EBITDA, but not at any cost, right? So they're really focused on improving and creating profitable growth, not just any kind of growth. So that means that they're looking at, predictable revenue streams, recurring revenue streams. They're thinking about, do they have defensible durable advantages in the market that will make their revenue stickier than their competitors. They're thinking that way. So they're investing and spending money and investing in things that will give them that sort of extra defense in the market and extra stickiness in the market. So they can use their capital more effectively in that regard. So I think that's a big difference with the maker. That's what they're really focused on.
You mean with the taker? I think it's a
No,
good.
I think we said we want to focus on the
Oh, I
maker
see.
first.
Okay, all
The
right.
maker first. That's what I think the maker does well, that they're
Hmm.
really focused on profitable growth, not just growth for growth's sake.
Sure, but I would make the argument that the taker does that too, right? Obviously you're looking at your P&L and your balance sheet. You want that to grow. You want to do those things. I would make the argument that the difference between the maker and the taker is the maker prioritizes understanding the things that are going to generate maximum enterprise value from the firm, right? So not just defensible growth and not just recurring revenue, those kinds of things. Really understands the levers that are going to drive the multiple. To me, that's the difference, right? So I agree with you completely that those things are important, but fundamentally, what the maker does is architects their business to optimize enterprise value and understands that there are certain characteristics of that business which will make that business more or less attractive to different types of investor, and then prioritizes investments to, I don't know, close a capability gap here, build defensible IP here, manage to scale, create a business model that allows that business to scale perhaps globally. Prioritizes, to your earlier point, a stronger, a more capable team at lower levels of the organization, prioritizes governance and the board, right? So understands that there are a number of levers to pull and works really hard to pull those to get that 4 to 5x, 5 to 6x, 6 to 7x multiple,
Yeah.
where I think the taker tends to manage the business off the budget, the P&L, and to a lesser degree, the balance sheet, um, only to really focus on kind of incremental investments that are kind of next year's growth and maybe the year after that. So, and it's interesting. We've worked with, I don't know, hundreds of mid-market CEOs on strategy, and very few of those CEOs uh, begin the conversation around strategy, around how do I optimize my enterprise value, right? The conversation is how do I beat this, how do I beat this competitor, or how
Right.
do I improve revenue? How do I double revenue? Whatever it is, right? But very infrequently, unless the business is positioning for exit in 1 to 3 years, does that conversation even begin to happen?
Yeah, I totally agree with you. And I guess sort of to reframe what I was saying, I think that the maker is focused on three things. Now, I only mentioned the first one, which is really improving the return on invested capital.
Hmm.
That's one of their big focuses for value creation that they do. The second one would be to improve operations. PE firms are very interested in companies that are not just managing well for today, but have businesses that are well positioned to be successful in the future. So to me, that would be important to them as well. And then I think the third aspect that they look at is the quality of the leadership and the board. I think those would be the three big buckets that they look for. And can this organization operate successfully and maybe even better if the leadership team or if the CEO stepped away from the business. I think those are the big areas that they look at for value creation. And then underneath those buckets are a number of different things that organizations can do. Definitely creating a moat, finding the moat that you can build for your organization where your competitors find it very difficult to replicate is important. Creating switching costs wherever you can, where it becomes hard for the customer to switch to your competitor because it would be costly for them to do so, or your company is so embedded in their operations that it would just be too costly. So all of these are strategies that companies can use to build out those three areas. But I think that those are the big buckets that make makers makers.
Hmm. I agree with all of that, but I think there's a more nuance to add to it because I think the maker has to triangulate um, their own view of value of the business, right? So some of those things sort of, yes, stand on their own merit, right? So
Yeah,
obviously, a business with a strong moat is better than one without one. A business
right.
with diverse talent is better than one without diverse talent. Um, a business that understands where to invest its limited resources into the highest return activities is better than one that can't do that. All those things are true, right? But I think you have to also understand, like the maker being almost an enterprise value architect, also has to think about um, first, what is the spread of value in their industry, right? So if
Right.
you're a professional services business or a manufacturing business or a financial services business, right? There'll be a range of valuation that that these businesses typically would experience in any kind of transaction, right? And there'll be a number of levers that drive those just in the normal course of business. So, for example, um, in certain industries, scale matters a lot, right? And in other industries, scalability matters a lot, right? And to your point earlier, certain businesses, operational performance and quality matters a lot. And, in other businesses, customer stickiness matters more, right? So it really kind of depends on which levers in which industry and what drives that spread evaluation. So that's one. And I think that, really understanding that is really important because you want to be on the far right of the bell curve where you're the one getting, those that extra juice in the valuation multiple, and you don't want to
Right.
be on the left, right? That's one. I think two is, almost thinking about different buyer scenarios or investor scenarios, because what a family office might want might be completely different than what different private equity businesses might want in they're investing in a particular, segment of the economy, and different again than what a trade sale buyer might want, who might just want a bolt-on capability or whatever. So I think it's important, like when you're thinking about these things, there isn't a universal truth of what drives value. That value is partly driven externally in terms of what does the buyer want and how can they leverage that value. So this is something I don't see very often. We think a lot about competition, but we don't do a lot of work to sort of imagine how different buyers would view um, my business through the lens of their investment story, right? So,
Right.
you know what I mean? So, those levers might be, not different at all or significantly different depending on those factors too. So I guess
But
my
when you
advice would be, is for business leaders to do the hard work to understand where those levers are relative to their own understanding of value, relative to the market's history in terms of where that value is created, and then through the lens of different buyer types.
So would you agree though that those, improving our return on invested capital, operational improvement, and even just sort of like the quality of the team are pretty common across the type of buyer that would show up? Or even if a
Yes, but
bank was
I
thinking
think that
about buying a
often,
bond?
yes, I agree with those things. Okay. But I think most of those things get you to the middle of the bell curve, but not to the far right of the bell curve. You know what I mean?
Okay.
Like, I think that, and it really is quite dependent on the sector, the industry, and the buyer, like I said a minute ago. So, I agree with all those things, and I stipulate that those stand on their own merit. Um, However, what's an investor looking for is an opportunity to create more value in the future. So they're going to buy this business, and there's going to be a gap there, typically, right? Which is um, almost an arbitrage between what the investor sees and what the seller or the
Hmm.
protagonist that we're talking about here, whether it's A or B, right? So they're going to find a way to extract some additional value out of that business. Now, the game
Right.
here is for the maker, ideally, to be able to capture more of that incremental value in the deal. So I agree those things matter. But just to add to the mix, it might be that a particular buyer would be more focused on, for example, IP or scalability of that IP, right? Which, you
Right.
know, for example, the buyer might already have train tracks to scale that IP somewhere else, whereas the seller doesn't. So, but they have the IP, right? So, you sort of bring these two ideas together, and the buyer can scale it, but the seller can't. So if that's driving the valuation multiple, then the maker needs to understand how do they put in place a mechanism to make that IP more attractive to someone wanting to scale that IP globally, right? So what capabilities need to be in the business? How do they defend the IP? How do they demonstrate that that IP can have, it gets traction in the market, whatever that might be. So all I'm saying is that sure, those are definitely key factors, but you need to kind of get pushed past that and really understand what are the things going to drive that extra multiple value. So you might
Yeah.
if you're a taker, you're going to be in the bottom quartile, right?
Right.
Um, if you're If you're a maker that's focused on the generic stuff, you're going to be in the middle, right down the middle. If you're a maker that's focused on really understanding where that really extra value is, then you're going to be further, the upper quartile. I think that's the way to think about it. But
Yeah,
also,
I mean, no, I was
sorry.
going to say, yeah, I agree. I think it's important to understand what's required for that upper quartile, depending
Okay,
on
we
the
agree
industry
on that, right?
right? We agree on that. And something like, IP or proprietary technology, all those things would resonate with a buyer and would probably get you more of a premium or a better multiple. So those are definitely important. I think that, if we go back to the original example, to your earlier point, if the industry, let's say average multiple be paid out was 10x and you're a taker, you might get anything anywhere from 6 to 9x, right? But if you're viewed as a maker, it could be that you get 12 to 14x,
Hmm.
depending on what have you done to make the business more valuable, to create value. That's what will really drive. So if you're in the upper quartile, that could be you. But I think that just the contrast from helping organizations and CEOs sort of get their head around whether they are, focusing on and managing current performance versus, to your earlier point, architecting value, enterprise value is, I think, a critical mindset that they have to wrestle with.
I don't think it's versus. I think it's an and, right? So you have to do both. There's no doubt about it, right? You have to run a great business but it's not enough if you want to unlock the extra value. So I think those things both count. Um,
Hmm.
but yeah, I think we're in agreement, Rondo. It's not like we're not agreeing here, except for the extent that I guess my only point is that you can be a maker and still end up in the middle, right? We don't want to be in the middle. We want to be in the upper quartile, right? So the trick is to unlock those levers that are going to really drive extra value. So I'll give you an example. In advance of sort of evaluating, this concept for the podcast, I just had a look at sort of um, where's AI influencing multiples in different industry sectors, right? I thought it was really interesting that it sort of matters most without any surprise in technology companies because we're in an infrastructure build phase of the AI story. Of course, it's huge, right? Um, Surprisingly, number two was manufacturing. Okay, so AI and the sort of the company's story around their ability to leverage that technology to
Absolutely.
improve manufacturing performance is high, right? Third was financial services, um, primarily, I think, because of kind of AI enabled at the front office and things like that, which plays a key role in reducing operating costs. But those were the only three industries that prioritized AI in the multiple value at this point in time. So I think it's
At
really
this point in time.
right at this point in time. That may change, but so then if you're not in one of those sectors, question mark, does AI add that extra value or not? You know what I mean? So it's one of these things where you got to be really clever to understand where that extra value is going to be, or someone will take that value from you. And I think that to me, that's the lesson. So first, right, if you're thinking about what advice would you give, CEO A or even CEO B, um, I think you have to be the value architect. You have to be, right? There's just no choice in this market where, um, you know, you can keep plodding along and create a good business, but inevitably, if you're not, you're going to leave value on the table for someone else to take that value. You know what I mean?
Hmm.
Why give up 1 or 2 points why give up 1 or 2x multiple value if you don't have to? So I think it's really quite important. I think the other thing you mentioned in terms of at the beginning, this sort of over concentration of leadership and things like that. Um, it's always an interesting question for leaders who um, have to consider at some point in their journey when to get out of the way a bit, right? So if your business is overly dependent and overly concentrated on your contributions, right? What does that mean, right? So how do I make that mental shift to you know, get out of the mindset that the business is about me to the business is about creating value for, for me and for my family, for whatever. I think that mindset shift is really important. I wouldn't mind spending a minute to unpack that. Like,
Yeah.
how do you help leaders break through that sort of notion that you've got to make the shift?
Yeah, I mean, I think about it as, they have to think about whether they are working in the business or on the business, right?
Hmm.
So if they're spending their time working in the business versus on the business, they're not going to be able to focus on the enterprise value as we talked about. So I think one way that you help them to do that is you get them to think about the what if scenarios. What if you got, the classic, what if you got hit by a bus tomorrow? What would happen to the business? And the importance of making sure that, key processes are documented, that succession plans are in place, all sort of bring, I think, attention and priority to this need to make sure that the business can run even when they're not there, even if something were to happen. So I think that making sure there's continuity and the business can run, maybe the business can even perform even better without them, I think would be important for them. So I would say getting them to imagine that terrible scenario where they could not be at the business, for whatever reason, and then what would happen.
Hmm. Okay. Another fun scenario would be what would happen if private equity knocked on the door, right? So, all of a sudden you're sitting there, it's a Tuesday, whatever. You get a phone call, the team comes in, they're looking at your business. Now, the taker automatically is going to be on the back foot with these guys because they know where all the value is and you don't know anything, right? So now the maker has already done the work and they understand that when private equity or some buyer enters the boardroom, they already understand where that value is and they understand for different types of buyers where those levers are going to be, and they've already thought through the story of I'm making capability investments here, technology investments there, whatever, right? And they understand that where the value is and how each party is going to take a share of that value. So I think that's just as interesting. I agree. What would happen if you got hit by a bus? Obviously, your estate needs to be able to realize that value. So if you care about your estate, that's certainly important. Um,
But
but
also, if you just care about your business, if your legacy is about making sure that your business endures long beyond you, it's important to make sure that it's set up in a way that allows for that. Right.
That's true, but not everyone cares about that, right? So
Hmm.
some people, yeah, I want to hand it off to the next generation. We all know that the success rate, second and third generation, is low. Um, but inevitably, there's three things that happen with every business. It plods along, right? Great. It gets sold, or there's some sort of equity event, or it goes out of business. I mean, that's it for every business.
Yeah.
So. And I think that the sort of the idea, let's talk not about going out of business. That's probably a podcast for another time. But most people aren't planning to fail. But
Right.
I think that too many CEOs, particularly founder-led CEOs, are planning to plot along and not planning to capitalize on the value of their hard work and investments. You know what I mean?
Yeah.
So I think
Yeah.
that's the planning mindset of, mindset A is just how do I just get more of what I've already got? And by the way, I think that's okay if that's a deliberate choice, right? So, you might be a CEO or a founder. This is a lifestyle business. I just want to generate enough cash flow. I can do my 40
Yes.
hours. It's okay. It's okay as long as it's completely deliberate and intentional. This is what I want, right? So I
Right.
don't really care if I sell the business and somebody gets more value. It's okay because I have what I need. No problem. As long as that is a choice, right?
Yeah.
The default is completely unsatisfying, right? So, but I think an even better if choice is, okay, actually, I'm not a plot along business. At some point, I will ask for capital, need capital, or I will exit, whatever that might look like, right? So
Right.
therefore, if I accept the inevitability of that, then there's really no other choice available to you than to make sure that you're positioning for the maximum possible value uh, at every moment. And then a big part of your strategy is how do you lay down the investments to unlock that extra value to be an upper quartile performer.
Well, I mean, I think so. So what you're saying then is it doesn't matter whether you're a lifestyle it's a lifestyle business or you want to leave a legacy. If you want to optimize ultimately the business is valued at so you can get optimal monies from the business, you've got to look at value creation as opposed to just managing for current performance. Because ultimately, if you want to get a loan, you want to get the best rate for that loan. You want fewer restrictions and covenants on the loan. All these things are taken in consideration. The valuation is taken in consideration when the bank looks at your company.
I totally agree with that, but I can see a scenario where someone would say, "No, I'm just happy to plod along, and then when it's time to retire, I'll shut down the business." Right? So that happens all the time, right? So but more to your point, and I exactly agree, more likely that people will plod along, and then they'll reach retirement age, and then they're going to need to unload the business. Oh, hang on a minute. Now I've got to exit now. Put their business up for sale, and someone will strip it clean, take advantage of you, and leave you with a significantly undervaluation of the business because you haven't been careful in planning to extract that extra value. I think
Right.
it happens all the time. So I agree with you. They're really, it's sort of a bit of a red herring in a sense that that sort of the plodding along person probably doesn't really intend to plod along, but
Right.
ego or you just don't know how to discover that extra value, or feel like life is too busy, whatever. There'll be a number of factors that play a role in that. Um, and they'll
Well, to
move
your
on
point,
with
they
it.
may be operating with a lifestyle mentality until it comes to the time to actually sell the business, and then they go,
Sure.
"Whoa!"
Right. So
Right.
therefore, I think that the conclusion I reach is that it's not an option, right?
Right.
You are creating or releasing capital at all times, right? And it's really a simple question. Are you the taker that's happy to plod along, or are you the maker that wants to create that value? And then to what degree do you have a full life cycle view of what value looks like? And
Mhm.
then the important question is, what are you going to do to architect that value, right? In addition to the other things you're doing, right, which is to make your firm more competitive and resilient and other things like that, which obviously play a role to getting you to the middle of the curve, but it's really about how do you take advantage of that. And also, we haven't talked about this. I think it's important to be to understand that you can be the buyer too, right? So
Right.
now your ability of a leader for how you stitch together value so that you can create that compounding effect. So, are you the acquirer or the acquiree, for example? Where is that extra value comes from understanding how you can put those bricks together into a house that that looks pretty valuable as compared to one that looks like a shanty.
Right.
Terrible
Yeah.
analogy.
So one of my clients was a building and materials distributor, and they were on an acquisition tear. And what their idea was to sort of acquire these smaller lumber and building materials companies and bring them into their business. And just by doing that, they increased the valuation of those revenues that they gained because they were at a higher multiple than those smaller businesses that they brought into the business. So they grew like five or six times in revenue over the year and a half that we were with them,
Hmm.
let
And
alone in
they
their
understood
valuation.
presumably that scale drives a multiple in that sector, right? And the
Exactly.
race to get that scale matters, right? So then the question is, how do I deploy my limited resources to achieve that scale?
To achieve it. Exactly.
You know what I mean? Which, probably I know for sure in that case there was there were partners, there were equity partners in that sort of that stitch up, right?
Yes.
And but I guess the point is that, here we are in 2026. Depending on where you are on the planet, you're going to see it's at least, for example, in Australia, I expect that this year will be a banner year for mid-market deals, particularly
Oh,
given
yeah.
some of the changes in regulation, which would make it harder to do bigger deals. We can go into that another time. But,
Hmm.
so under the radar deal flow will be high this year, right? And maybe in the US, it's a little bit different in a sense that, mega deals are kind of on the rise. And, sort of different markets have different characteristics. But, I think that we should see, notwithstanding all the kind of global uncertainty, we should see a pretty big year for deal flow this year.
Yeah, I mean, in the US, their expectation is that, the big AI companies are going to suck up a lot of the capital that's going to be flowing in 2026. But there's, I think, something like $2.7 trillion of money that was, sitting on the sidelines from PE companies that they're going to be looking to spend this year.
Hmm.
So I would imagine some of the smaller deals will also get done as well.
Right. So, in summary, the insurgent leader, be a taker, okay? No, be a maker. Okay. You
Right.
do not want to be a taker. Okay. So your default is probably taker. Make the shift. The mindset shift is the key here. Okay. And the idea is to architect value for future opportunity for your business and to do that on the front foot, not the back foot. That's the summary. I think that is the key.
Yeah, and I think for those listening, I think you have to ask your CEO or founder or board member, are you a maker? And if you're not a maker, ask them, do you recognize that, we're leaving value on the table by not being a maker?
By definition, right? And this is
Yeah.
a one area where mindset makes such a difference because, you know, the taker 100% always will leave value on the table,
Yeah.
bottom line.
Awesome.
Very good. Well, fun topic, Rondo. And, I think there's lots of opportunity to bring some interesting guests in this space to talk a little bit more about the nuance in different markets. So we'll aim to do that later in the year.
Yes, sounds great.
Very good. Have a good weekend.
You too, Matt.
All right. Don't forget to find us on Apple Podcasts, Spotify, and YouTube. Look forward to seeing you next week.